Tyler Vinson here, and today I want to talk about how to create the most advantageous real estate portfolio. As a passive real estate investor, or what we call a LP, a limited partner, you're going to be taking a look at different real estate investment opportunities. If you're on retokens.com, you're going to be looking at different real estate opportunities that are tokenized, and they will all have different benefits. So I just want to talk about how to optimize a real estate investment portfolio and the things that you should be thinking about. So one of the primary things is, of course, going to be cash flow. There's a cash flow play in real estate investments. What is my cash on cash return going to be in this particular investment? You'll see return numbers like IRR used, internal rate of return, and be aware that means cash flow plus equity and actually has a time variable in there. So something that says 16% IRR or 13% IRR definitely does not mean that that is going to be the cash on cash return. Of course, cash on cash return, if I put in $1 and I get $1.10 or I get 10 cents back, then that's going to be a 10% cash on cash return. So that's one of the plays to consider when you're optimizing your portfolio. What type of cash on cash return am I looking for? Another type of investment might be an equity play. All right. So a cash on cash return that we just talked about may be a building that's already performing, maybe an apartment building that they want to do what's called a value add and raise the rents or something like that. But most of the equity is already realized in the price, meaning you're going to pay close to what the property is worth because it's kicking off that cash flow. But in an equity play, that could be a development project. So a lot of new development projects are equity plays. That could even be in a redevelopment or repositioning type project where when they go in and buy it, it's not going to cash flow out of the gate. Maybe they need to pull the tenant base out of there and remodel the building, upgrade the building, do those types of things, put new tenant base in there at a higher rate. And ultimately, that will pay a cash on cash return, but you probably have a much higher equity play in a building like that and a lower cash on cash return than just buying into, say, an apartment building that's performing. And then the third thing to take a look at when optimizing the portfolio is there tax benefit going on in this real estate project? So that could be anything from there's still opportunity zones out there, so an opportunity zone type of development, or just a regular depreciation schedule from the real estate itself. You see, one of the magic factors in real estate is something called depreciation of the property. So when we do our tax returns, no tax advice given, but typically when you do your tax return, you're going to have a certain type of actual net income, but then you will be able to depreciate a certain amount of the building that goes against that income as an expense on the tax return. So even though you actually didn't pay out of pocket for that, it reduces the taxable income on the building, and that can reduce your taxable income as well. Because as a real estate security token holder, you will have, on a pro rata basis, depending on how many tokens you have, you will have the same benefits as the general partner or the syndicator that's in there in most cases. That means that the depreciation on a building will be separated out on a pro rata basis, kind of a per token basis, if you will. So however many tokens that you own, you will get those tax benefits as well. So if you're on retokens.com and you're looking at different investment projects and you really want to optimize, you may look at the three categories here and say, okay, how much cash flow do I really want in my portfolio versus how much equity upside potential do I want on my portfolio, and or what do I need in the form of tax benefits in my portfolio. And you can literally invest and optimize that however you want. It's one of the beauties and one of the powers of tokenized real estate is it makes it much easier to diversify and optimize the portfolio how you want it. So just like with any investment, somebody who's in it for the long game, maybe they're have a high paying job right now that they work, they may be more into say the equity play or perhaps even the tax benefit play depending on their personal tax situation. But if somebody is closer to retirement years or in their retirement years, they may want to focus on those cash on cash returns or the cash flow play that's there. So those are things to consider when you're really looking to build the most advantageous real estate portfolio for yourself. So let's just talk a little bit about what type of real estate investments normally fall into each of those three categories. So when it comes to cash flow, often you're going to see what we call a value add real estate investment. That's where a general partner or a syndicator buys the real estate. It's typically already cash flowing, and they're going to do things to the property, maybe a rent increase, updating the building, adding amenities that generate more revenue, reducing expenses. They're going to do things to add value to the property and really maximize and increase that cash on cash return. It's normally that type of play. Yes, it tends to increase the equity as well, but really they're focused on that cash on cash return. To where a new development or a redevelopment is going to be focused on a strong equity play there, right? So if it's a new development, obviously you're not going to really have any type of cash on cash return until that thing is completely done and fully rented out. And even then, there may be some initial expenses to cover before you see any level of cash flow. Same with the redevelopment. If they have to go in and redo the entire thing or most of the building and pull a lot of that tenant base out of there, then there's not going to be that cash on cash return. But by the time they do what they're doing in the redevelopment and release it out at much higher rent rates, that's going to be a large equity play there. So there's that type of investment. And then there's something in the real estate world called a cost segregation. And what that is where they accelerate that depreciation I talked about on the real estate. So in this hypothetical situation, there could be a project on there where somebody's talking about the fact that they did a cost segregation and they're accelerating that depreciation. So there'll be more tax advantage against the income, more of that kind of phantom loss, if you will, in the form of depreciation. Or we talked earlier about the opportunity zone example. Those have additional tax benefits to them as well. So those are the type to consider. You either have large opportunities, which may have big time equity plays or tax plays, or you may have strong stabilized buildings with low risk and strong cash on cash return. Whatever lines up with your investment interests is how you can invest with tokenized real estate, and that's how you build the most advantageous real estate portfolio for you.